Hi, this is part two of the analysis that we are actually working on in terms of evaluating different financial ratios and matrices that you can look at it from fundamental analysis. So, we discussed about the share value ratios and metrics that gives you an indication of how well the company is in terms of, again, the valuation, in terms of looking at each of the shares per share basis, all of the metrics. Now what we're going to do is we're going to look at the financial ratios. Okay, financial ratios usually come from balance sheets. Okay, they are mostly looking at the assets and liability both on a short term and a long term basis. So we can create certain metrics that actually look at some of the important matrices that you have to evaluate. The first one I can talk about is the long-term debt to capital. Okay, which is again looking at the overall long-term debt divided by the long-term debt plus the shareholder equity. Okay, what it tells you is that it tells you the overall capital structure of the company and the financial risk that is associated with the company, because most of the company, they run on a very high debt, and then let's say they have a very good or probably not a good cash flow to cover up a lot of the high interest that they might be carrying in the balance sheet. So this provides an indication in terms of how good their capital structure is, and are there any financial risk associated with the company. Okay, not we are not looking at the short-term debt, but we are looking at the overall long-term debt and trying to figure out how good the health of the company is, right? From a financial leverage standpoint, that is basically again looking at the overall asset divided by the shareholder equity. Okay, again, if you have higher financial leverage, this value is going to be much higher. Okay, what it tells you is that the overall debt that you might be carrying in your balance sheet might be much higher and you're very high levered. Okay, so the assets are going to add up to a lot of the liabilities that you might have, but your equity valuation is much lower. Okay, the rest of the asset minus the liability, right, that portion might be much lower, and plus you're carrying a lot of the financial leverage in your company's balance sheet. Okay, this financial leverage is a very good indicator of the fact that most of the companies, especially the high debt company that are basically looking for a future growth and future revenues, it might be much higher, and you have to be very careful. Okay, from those companies. The other one that you can look at is the fixed charge coverage ratio, which basically is the ability to cover the fixed financial obligation. This is basically again gives you an idea about the credit and the debt servicing that you might have in the company. So it's earning per earning before income and tax plus the fixed charges divided by fixed charges plus the interest expense. Okay, so you're looking at the earnings, you're looking at any of the fixed charges you have, the interest expenses that the company is carrying. You can also consider tax implication factors as well, like in terms of the overall expense. So a lot of those factors can be evaluated and looked at in this ratio. So it's very important for any company when you're looking at the overall credit and the debt servicing that they might have. Okay, the dividend payout, which as a percentage of earning, is very important for especially for income generating portfolios and asset manager or portfolio managers who are looking for investing in a company that has a very good dividend payout. Okay, this probably is one of the factors that they're going to be looking at. Okay, EBIT divided by the interest expense, like how fundamentally how strong they are in terms of paying all the dividends, or in the past and in the future. Are the dividend rates increasing year over year? Is the company able to meet the obligation in terms of paying those dividends? And overall share value, is it going up or down? Okay, so this is going to be a very good indicator that that will give you the sense of how good the company is from a payout standpoint. Okay, the quick and the current ratio, okay, these are again very much focused on the short term debt obligation, short terms cash reserves. Okay, if any of these companies that have a higher quick and current ratio, that means they're carrying a lot of liquidity in their balance sheet, and they're able to actually jump into the investments that or the current investment opportunities that they might have, or may be able to pay down some of the short-term liabilities very quickly. Okay, because what it tells you is that if you have a higher cash reserves and if you have a lot of receivables, okay, which is again short term, that means less than 12 months, you will be able to make an investment. okay, very quickly, and you are able to sustain some of the crisis, or probably like black swan events as well, because you're very conservative on the liquidity measures, and your working capital is also very healthy. Okay, so these quick and current ratio can provide you indication of how good the company is in terms of meeting those obligations. Okay, so this is the end of part 2. We'll talk more about profitability metrics in the next video. Thanks.